When you get to retirement, it's likely that your pension will be one of your largest financial assets. At that point, you're going to need to make a critical decision that could dramatically affect your quality of life, for the better or for the worse. One of the key benefits of a pension is that at retirement, you can typically draw up to 25% of its value down without paying any tax. And you need to decide whether to take this all at once as a tax-free cash lump sum or bit by bit over time. This decision is far more consequential than most people realize. And as I'm about to show you, mistakes here can end up costing you thousands of pounds in tax. The standard advice that you might have heard is to do the latter, to preserve it, give it the opportunity to keep growing, and then draw it down slowly through retirement to help minimize tax. However, recently announced changes to pensions and speculation that the government could reduce or remove the tax-free benefit entirely has many people wondering, is that still good advice? Maybe it's time to take your tax-free cash whilst you still can. Well, as a financial advisor, I'm here to tell you that, yeah, maybe you should, but perhaps not for the reasons you're thinking. So in this video, I'm going to give you the 7 valid reasons you might want to consider taking tax-free cash from your pension as soon as you can. Obviously, if you are already retired, the lessons you're about to learn are imperative. But if you are many years from retirement, it's still critical that you understand this stuff, as this may affect your plan for the future and consequently the decisions you should be making today. Before we get into the reasons, let's do a quick 1-minute recap on how pensions and tax-free cash work. There are 2 main types of pension in the UK. Defined benefit pensions, which are now typically only found in the public sector and pay a guaranteed income on retirement, typically based on your salary and how many years you've worked. We also have defined contribution pensions, the most common type of pension, which is essentially a tax-efficient investment account that you and perhaps also your employer pay money into. The decision about when to take tax-free cash mainly relates to defined contribution pensions, because with a defined benefit pension, firstly, not all schemes offer tax-free cash, and secondly, you typically have to take it all as a lump sum when you start drawing your pension. The only option you may have is how much tax-free cash to take. So, although this video is going to focus on defined contribution pensions, if you do have a defined benefit pension, some of the reasons we're going to look at will still be relevant for helping you make that decision. With a DC pension, you get tax relief when you put money into it, it then gets invested, and once you hit retirement age, you can draw money out again. You can typically draw up to 25% of the value of your pension without paying tax, whilst you have to pay marginal rates of income tax when you draw down the other 75%. Now, before we get into the first reason for why you might want to take all of your tax-free cash at the start of retirement, let's first look at an example of why you might not want to do that and instead draw it down gradually over time. Jane is 62 years old, has £300,000 in her DC pension, and is planning on spending £20,000 per year in retirement. To create her income, she can either draw down on the taxable part of her pension or the tax-free part, or a combination of the two. If she drew her income from the tax-free part, great, she has no tax to pay today. But if she keeps doing that for say 4 or 5 years, she'll likely deplete it and have no other option but to then take all of her future income from the taxable part of her pension. We each have a personal allowance that means that we don't pay tax on the first £12,570 of income we receive. However, in 5 years' time, Jane will be in receipt of the state pension, which will probably take up all of her personal allowance, which means that Jane will now have to pay basic rate tax on anything she draws from the taxable part of her pension. When it comes to pensions, the game is to get as much tax relief as you can when you're putting money in and pay as little tax as you can when you're taking money out. And there are far more tax-efficient ways that Jane could have done this. Instead of taking all of her tax-free cash right at the start of retirement, Jane could draw down £12,570 from the taxable part of her pension, but because this falls within her personal allowance, there would be no tax to pay on it. As part of this withdrawal, she would have to take the corresponding 25% of tax-free cash, which means that she would have £16,760 of income tax-free. She can then choose to take the remaining income she needs, either from tax-free cash or a combination of the two. In our first example, because Jane depleted her tax-free cash up front, she was looking at the prospect of paying 20% tax on all her taxable pension withdrawals. But with this approach, by taking this money out tax-free, she's saving £2,514 in tax per year. And by preserving the tax-free part of her pension, she's giving it more time to grow so that she can potentially draw down even more tax-free cash in the future, which means that this strategy could well save Jane tens of thousands of pounds in tax over her lifetime. So I hope this demonstrates that although drawing money from the tax-free part of your pension, or perhaps even your ISA, may seem like a great option because it's tax-free, that's not really the case if it ends up costing you way more tax in the future. This is why the standard advice that you hear is don't take your tax-free cash at the start of retirement. Instead, give it the opportunity to grow further and draw it down tactically to try and minimize the tax that you pay on the taxable part of your pension. But that is not always good advice. Sometimes there are very good reasons to take your tax-free cash as soon as you can, reasons that have been bolstered by recent changes to pensions and the risk of future changes to tax-free cash. So, what are these reasons? Reason number one. Let's say Jane also has £75,000 remaining on her mortgage, and she's looking at taking tax-free cash from her pension to pay this off. If she's currently paying 4.5% interest on her mortgage, by using tax-free cash to pay this off, she would essentially be getting a guaranteed 4.5% return on that money. Yes, there is a chance that she could potentially get a higher return by keeping that money in the pension, but that return is not guaranteed. So this could be a good option for Jane, especially if she thinks she'll value the qualitative benefits that come with being debt-free. Paying off debt is probably the number one reason why people decide to take tax-free cash at the start of retirement. They do a simple analysis like this and they conclude that they'll be better off paying off the debt. But this is where most people make mistakes, because they forget that yes, by paying off that debt, Jane will effectively be getting a 4.5% guaranteed return. But as we saw before, by using up all of her tax-free cash now, Jane is likely to end up having to pay way more tax on her future pension withdrawals. So if she ends up having to pay, say, £10,000 more in tax over the next few years, suddenly this option doesn't look that attractive. So yes, although using tax-free cash to pay off a mortgage can be a good idea, you really need to think about how much more tax you're going to have to pay in the future as a result. Reason number two. Let's say that Jane is married to Jeff, who is still working, but started saving for retirement later in life, so has £50,000 in his DC pension. If Jane took tax-free cash from her pension, she could give it to Jeff to contribute to his own. Say Jane takes £8,000 from hers. When Jeff puts this into his pension, the pension provider will add basic rate tax relief on top, leaving him with £10,000 in his pension, which is great because between them, they're getting a 25% boost on this money. However, we also need to consider what tax Jeff is likely to pay when he draws money back out of the pension. As we know, 25% of his pension can be drawn down tax-free, whilst the other 75% will be taxable. If Jeff retires before he hits state pension age, it's likely that he'll be able to draw this money back out of his pension without paying any tax. So that end to end, this strategy has netted them an extra £2,000. But even if Jeff has to pay basic rate tax on his pension withdrawals, they would still be £500 better off. Taking tax-free cash and using it to boost your spouse's pension can be a highly effective strategy, especially if they are higher or additional rate taxpayers. Not only because you're essentially getting a second set of tax relief on this money, but having a good balance of pension assets between you and your partner allows you to be more tactical with how you draw your income in retirement to help minimize tax. However, you just need to be mindful that the maximum you can contribute to a pension and benefit from tax relief in a given year is the lower of £60,000 or what you earn. So if Jeff earned £20,000 this year, that's the maximum that he can contribute inclusive of tax relief. But the handy thing is that even if you're not earning anything, you can contribute up to £2,880 into a pension and you'll still get the 20% tax relief added on top. Reason number three. The longer you leave your pension invested, the larger it should grow, enabling you to draw even more tax-free cash in the future. However, there is a lump sum allowance that limits the amount of tax-free cash that you can draw over your lifetime to £268,275. So once your pension has grown above £1,073,100, any further growth won't increase the amount of tax-free cash you can draw. Once you're past retirement age, your remaining tax-free cash, so the tax-free part of your pension, and an ISA have almost identical benefits. Money within them can grow free of income and capital gains tax, and you don't have to pay any tax when you take money out of them. However, unlike tax-free cash, there is no limit on how large your ISAs can grow, which means that you could take tax-free cash from your pension and put it into an ISA, invest it in exactly the same thing, and it could keep growing. This is a tactic that we often use with clients who are at or likely to hit the lump sum allowance at some point in the future. But before you do this, there's a few things you need to be mindful of. Firstly, due to the £20,000 annual ISA allowance, you may need to do this gradually over a number of years. Secondly, if you're concerned about inheritance tax, this might not be such a good option, because if you were to die today, any money inside of your pension falls outside of your estate, so no inheritance tax would be due on it. But if you take it out of your pension and put it into an ISA, it may be liable for inheritance tax. This added benefit of a pension means that it typically does not make sense to use tax-free cash to sub an ISA if you're in any way concerned about IHT. However, from April 2027, this benefit is being removed and pensions will form part of your estate. But even then, if you're concerned about inheritance tax, retaining tax-free cash could still be advantageous, as I'll explain in reason number 7. Reason number 4. Investing is a lot like growing vegetables. If you pick the right vegetables and look after them properly, they should grow so that at some point in the future, you can harvest them. And if you want to give your vegetables the best chance of success, you can put them in a greenhouse, a structure that is especially designed to protect them from the elements to help them grow as fast as possible. A greenhouse does what it says on the tin. So if you find that you're not getting the growth you hoped for, don't blame the greenhouse. It's probably because you picked the wrong vegetables or you're not looking after them properly. Pensions and ISAs are just like greenhouses. They're wrappers that protect your investments from tax, which should enable them to grow faster than they would outside. But just like a greenhouse, you still need to make sure that you're picking the right investments within your pension and looking after them. Pensions and ISAs do exactly what they say on the tin. So if your pension has not grown as well as you'd hoped, it's not the pension that's at fault, it's the investments within that are the problem. I say this because one of the main reasons people choose to take tax-free cash from their pensions is because they've performed poorly in the past and they think that they can get a better return elsewhere. But that is based on a fundamental misunderstanding of how pensions work. With a workplace pension, your money will automatically be invested into a default investment fund. But you should not assume that that fund is any good or appropriate for your specific needs. Just like if you bought a greenhouse that came with a starter pack of seeds, you're not just going to go and stick with those seeds and hope for the best. You're going to want to go and find the best vegetables to grow that are going to give you the specific diet that you're looking for. Well, it's exactly the same with a pension. It's your responsibility to make sure it's invested correctly for the goals that you want to achieve. Within a pension, you can pretty much invest in anything that you want. Yes, maybe your current workplace pension has limited options, but you can typically move that to a pension provider that gives you access to the entire universe of investments. Taking your money out of a pension to try and get a better return elsewhere is exactly like taking your vegetables out of a greenhouse and trying to grow them outside. And I don't know if you've noticed, but in the UK, we don't exactly have the best environment for growing things outside. And it's exactly the same for investing. Taxes in the UK are high and rising. Capital gains taxes have gone up, allowances have gone down, and property investors have been taking a beating for years that is only getting worse. Which is why you need to make the most of pensions and ISAs, these greenhouses that give your investments the best chances of success. Now, this is not always the case. There will be certain situations where it does make sense to take tax-free cash to invest elsewhere, but those situations are rare. So if you can think of one, please do let me know down in the comments and I will give you my opinion on whether that counts. Reason number 5. As we know, pensions and ISAs are fantastic tools for sheltering our investments from tax. But the problem with any scheme that comes with tax advantages is that governments can and do tinker with the rules. Don't get me wrong, I would much rather have these tools and accept that the rules might change in the future than not have them at all, but it makes planning for the future even harder than it already is. What's worse is that before every budget, the media endlessly speculates about what changes governments may make, causing a lot of unnecessary fear and confusion, which can lead people to make knee-jerk decisions that they may come to regret. And the last budget was no different. Back in October, rumour had it that Rachel Reeves was poised to reduce or remove the tax-free cash benefit of pensions, which resulted in a rush of people taking all of their tax-free cash, which unfortunately they came to regret when nothing happened. Of course, the government could still make changes to tax-free cash in the future, but as I have said many times before, I think it is highly unlikely that any changes will be brought in immediately. Just think about the chaos that would be caused if they reduced or removed tax-free cash overnight. Not only for those that are already retired, but for those that are just about to. So I expect any changes like this to be telegraphed well in advance and transitional protections to be introduced so that people that are near retirement can retain their rights, exactly as has happened when changes like this have happened in the past. The problem with speculating about what changes a government may make in the future is that they could change anything. It could be pension rules, ISAs, it could be CGT, IHT. So if you're trying to predict what is going to happen and make the changes off the back of that, there is a big risk that you could end up jumping out of the frying pan and into the fire. From my perspective, there are only two rational ways to deal with the threat of legislation change. You either block out the noise, stop tying yourself in knots and just play the rules as they are, or in certain situations, you may decide that it's worth taking some tax-free cash to hedge your bets against future legislative changes. Take Jane as an example, whose only financial asset is her pension. She may take the view that taking some tax-free cash from her pension and using it to contribute to an ISA has few downsides given that she's not concerned about inheritance tax. And this would then give her diversity across two different tax wrappers so that if one of them gets hit by a legislative change, the impact on her financial plans are less. But you really need to weigh up the chances of a change happening and it affecting you negatively with the downsides of making this hedge, because most people overestimate the chances of a change and don't fully understand the downsides of taking tax-free cash. Reason number 6. The whole point of saving money is so that you can spend and enjoy it at some point in the future. But because we have no idea how long we're going to live, we have no idea how long we need to make our savings last. When I first speak to clients about this, they often half joke that they'll never get to 80 years old. And even if they do, they'll just take themselves off to Switzerland. So there's no point planning beyond that point. But based on ONS statistics, if you're in good health, there is a very good chance that you'll live well into your 80s and perhaps even your 90s. And I know that even the most staunch fans of Switzerland tend to become zealots for life towards the end. Many people do not appreciate this and become short-sighted with the way that they spend their savings, only to deeply regret that decision later on in life. However, if you do have a health condition that genuinely means that you have a shorter life expectancy, then it absolutely can make sense to draw down tax-free cash early on so that you can enjoy it. However, I would suggest seeking financial advice before you do, as you really don't want to misjudge this. Reason number 7, working out how much money you need to sustain yourself in retirement is really hard. But if you are confident that you have more than enough already and you're ready to start giving money away, taking tax-free cash from your pension to give to your children or other family members can be a valid option. However, a pension is normally one of the last assets you would look to give away. Because firstly, as we looked at before, pension and ISAs are these greenhouses that protect our investments from tax. Therefore, if you have other assets that are outside of these wrappers, it often makes sense to give that money away first so that you can preserve the money inside these tax-efficient greenhouses. And again, until April 2027, your pension will fall outside of your estate for IHT purposes. So if you're concerned about IHT, giving away other assets that are inside of your estate, like ISAs, is likely to be a better option. Even after April 2027, in many cases, a pension would still be one of the last things that you'd want to give away. As an example, if you cash in an ISA and give the money to anyone other than your spouse, you have to survive for at least 7 years for it to be fully outside of your estate for IHT purposes. But if you take income from the tax-free or taxable part of your pension and give that away, it could be immediately outside of your estate if it qualifies for the gifts out of excess income exemption. And this ability to rapidly get money out of your estate can be really useful in the final years of life. So at a high level, this means that if IHT is a concern for you, even beyond April 2027, a pension is still going to be the last asset that you'd want to give away in many situations. But there are a lot of nuances to this gifts out of excess income rule, which I go into in a lot more detail in this video here, that explains the new status quo for retirement planning strategies given the recent changes to pensions. So I'll see you there.